Good morning, everyone, and welcome to this month's edition of our webinar series. We're going to be discussing recent premium reductions in the auto market world and more generally how rates are set. We appreciate everyone joining us. This and all of our webinars are available on our YouTube page, so check that out. We'll put a link in the chat there. And speaking of the chat, we're happy to entertain questions. If you have any during the presentation, please put them into the chat box, and we will address those at the end. I'm now happy to introduce our Commissioner, DJ Bettencourt.
Well, thank you, Andrew, and good morning, everyone. Thank you so much for joining this month's webinar. You know, it was funny, just yesterday, Deputy Commissioner Nyan and I were having a meeting with someone who was asking a little bit about the insurance department, what we do here, the challenges that we're facing, the issues that we're confronting. And we were going through the list of things, and at the end, the individual we were talking with said, "So do you have any good news for us?" And I said, boy, I've done a poor job of this presentation to you if I've failed to include a lot of the good things that are going on here in New Hampshire's insurance market. And one of the things that certainly has been a huge positive recently has been that auto insurance costs in New Hampshire are declining, with multiple carriers implementing some real meaningful rate reductions. Just recently, for example, Nationwide announced a 10% average rate decrease, with Allstate coming in at 10%, Travelers a 4% reduction, State Farm an 11% reduction, with a dividend payment of approximately $80 per vehicle here in New Hampshire. That is great news for New Hampshire consumers, and it demonstrates the strength of New Hampshire's personal auto insurance market. But you know, that's the good news. But there's a real science that goes into all of this. And so what we're hoping to do today is not just share some of that good news, not just share those wins for the consumer, but also for us to be able to provide you with a little bit of information as to what goes into setting rates for insurance products, the math of it, the formula, the regulatory guardrails that are in place, if you will, and help to demystify that process just a little bit so the consumers can walk away understanding that setting rates isn't just a random process. It's actually something that experts, actuaries engage with very intensely and take very, very seriously. And that's what produces the numbers that you see when you're quoted for coverage or when you get your monthly premium. And so to help us do that, I think we've got Christian Citarella is going to lead today's presentation. Christian is our Property and Casualty Actuary. He and Sean Ruzine lead that market. They do a phenomenal job, and I'm looking forward to today's presentation. So Christian, I'll turn it over to you.
Thank you, Commissioner. Yeah, so we're going to be talking about recent activity in the personal auto market. And yes, we've had some excellent news to report. And absolutely, as the Commissioner mentioned, there are some carriers that are actually filing some rate reductions. What I thought I'd do first is go through some, as the Commissioner mentioned, some of the laws, some of the oversight, some of the process of filing auto rate changes. And so all of these rate filings and how we review rate filings is governed by, of course, our laws in the state of New Hampshire. In New Hampshire, we have several laws and statutes and regulations that oversee this. RSA 412, 15, and 16 basically set up expectations for what we expect in rates and rate making. For RSA 412.16 goes through what types of insurance products need to be filed with us and goes through the details of that. INS these are the rules in the insurance regulations. INS 5000 talks about how forms and rates need to be filed. INS 1400 deals with specifically with private passenger auto, and declares like who qualifies and what vehicles qualify as eligible, what kind of past experience is allowed to be used in rate making and that sort of thing. INS 2800 deals with the situation where an insurance carrier may use and adopt the loss costs of an advisory organization to set their rates. This happens if there's a new carrier entering the market and doesn't have the kind of recent loss experience within the state that we would expect them to have. INS 3300 governs the use of what are called insurance scores. This is where credit scores and credit history may be used as a rating factor and may affect personal lines premium calculation. And there are certain rules in there. There are certain types of credit history, credit experiences that are not permitted in developing these insurance scores. So I wanted to just go through and describe sort of the two general types of rate filings and what may motivate an insurance carrier to submit a rate filing. So as mentioned, there are generally two reasons that a carrier will submit a rate filing. Either they've noticed that across the board, there needs to be a change in what they're charging. And that happens if their overall experience is either better or worse than what they expected, and there's reason to believe that going forward, they're going to see a change in the trend of claims. And so they'll just put across the board, oftentimes it's an increase, but as we've seen, as the commissioner mentioned, we have seen some carriers do reductions. The other possibility is that a carrier has noticed a change in some risk characteristic, or they've noticed a whole new class. They've noticed a new risk characteristic or some variable that is affecting good risks from, differentiating good risks from questionable risks, and they want to take advantage of that, as a market advantage. So when an actuary looks into pricing a product, the Casualty Actuarial Society, the CAS, which is the professional organization that credentials property and casualty actuaries, they have a set of principles of rate making. Now, to be clear, this is not New Hampshire law. This is professional. These are the principles that an actuary is held to, like as ethics in their profession. And it's kind of the foundation of how to price an insurance product. It's important to remember that a rate is an estimate of expected value of future costs, that the rate provides for all costs associated with the transfer of risk, that a rate provides for the costs associated with an individual risk transfer, and generally speaking, a rate is reasonable and not excessive, inadequate, or unfairly discriminatory if it is an actuarially sound estimate of the expected value of all future costs associated with an individual risk transfer. So what I'm going to do in the next few slides is kind of take those principles piece by piece and try to describe how we see that in the pricing of auto insurance. So the first one, of course, is a rate is an estimate of the expected value of future costs. Insurance is a unique product in that the carrier, the seller, does not know for sure how much the product is going to cost. They do the best they can in anticipating the costs that will come from that transfer of risk. And so they will look at past experience and patterns of change, trend, to project the costs going forward. And then they charge day one of the policy what they anticipate the costs to them will be for the coverage they're providing. A rate provides for all the costs associated with the transfer of risk. Claims payouts are not the only thing that an insurance carrier is dealing with or expecting. And so for this is sort of an aggregate or an average. Not all companies break out their premium this way, but this is kind of a general, representation of what I see in the auto market. So generally speaking, if you have 100% of premium, it's going to break out roughly about 55 to somewhere between 55 and 65% of the premium is going to go to paying claims. Those claims need to be adjusted. They need to be investigated. So that's going to be about 8% of the premium is going to go paying for that work. Of course, commissions for agents is going to be 12%, somewhere in the 8 to 15% range, depending on the company and how they go about selling their product. Taxes, licenses, and fees is usually about somewhere between 1.5% and 2%, and that's across the board. Other acquisition and general expenses. So this has to do with marketing, this has to do with outreach, this has to do with whatever it takes to acquire that new business. That's usually in the 10 to 15% range, maybe a little bit more. And then, of course, profit and contingencies. That contingencies piece is because they don't know how many, what they're going to be paying out in claims, how much it's going to cost in adjusting, and those sorts of things. And then, of course, they're expected. It is understood that an insurance carrier is going to make some profit. So the third principle is that the rate provides for the costs associated with an individual risk transfer. And this is where they craft the premium to meet the risk of the individual driver with those individual vehicles. And so personal auto rating factors that we see, of course, start with the year, make, and model, also known as the symbol for the vehicle, and insurance carriers will provide with us the symbols or the codes for all makes and models and years of all the vehicles that are available out there. Those symbols are associated with, usually it's the base rate or rating factor for their product. Territory will make a difference, less so in New Hampshire than in other states, but there's a difference to what it's going to cost to provide coverage, down in the southern tier of the state versus, north of the lakes. Age and gender of the drivers, marital status, prior claims, moving violations, insurance score. That's where the prior recent credit of the policyholder is going to come in. How you decide to craft your particular policy, as far as what you choose in your liability limits, and also how you select your deductibles. That's going to have an effect on what you're paying in premium. And there are many, many others. I didn't mention telematics or the use of user-based insurance. This is where you agree to allow the carrier to monitor your driving habits, and then your premium will adjust according to how you drive. There are many other rating factors and variables that are used. So what I want to do is then take you through very quickly what we see in the department when an insurance company wants to change their rates. And so we see what is called a rate indication. This is a kind of a simplified version of what we see. Generally, they need to describe what kind of increase they need. Now, this is an older one. This is approximately, I think this was put 4 rate changes in 2024, so this was submitted in 2023. You can see the indicated rate change that they're requesting down at the bottom is 16.3%. This was back in the days when we saw large increases. And what we're seeing here is, of course, that they have some expenses, that the projected loss and ALA, that's the expenses associated with adjusting claims, is higher than what they're prepared to pay. And so they're seeing that the experience is adverse to their expectations, and so they need to increase their rates. A couple other things you'll notice there is that they're using experience from 3 years, and then they're also building in, you'll see in line, 19, that credibility. This is something that is very important because as a small state, not all insurance carriers are what we call fully credible. The experience within the state is not adequate to do a reasonable, or they're not confident in their selections. So how they handle that credibility is something we work with them and to understand. Some carriers will look into the region and get more experience that way. Other carriers will do like an a priori assumption, go back to where they had been in the previous rate setting to kind of mute the effects of recent activity if they believe some of their original assumptions. Other things here to keep in mind, we have trend, we have those severity trend and frequency trend get built into the trend factors on their losses, and we can talk about that a little more ahead. So what I want to now focus on, of course, is what we're seeing in recent activity. So this chart here just shows how much of our in-force premium, like how much of the market that is out there is affected by rate changes in each of the last 7 years, 6 years. We have very little from 2026. So, and it's very important to remember what was going on at the time. So in 2020, this is when COVID was happening, and carriers were very, they really didn't know what to expect, and so very little of the market saw any kind of rate change. Then in 2021, we saw a great amount, more than usual, of the market was affected by rate changes. We saw a lot of rate changes coming in at that point, and that continued for another year. And at this time, carriers started filing multiple rate filings per year, and the rate filings were for rate increases. And then you can see that it's kind of tailed off some over the next few years, where I would say back in last year, and these are rate filings that were submitted in 2024, most of them were submitted in 2024 to take effect in 2025, back down to what I would consider to be somewhat of a normal pace. 50, somewhere between 50 and 70% of the market, 50 and 60% of the market affected by rate changes. So we're yet to see what's going to happen in 2026, but I wouldn't be surprised if we're back down into that, 50% range where we had been before COVID. So what's happening during these rate changes is you see on this next slide. So prior to 2021, and in 2021, we saw very little in the effects of rate changes. If anything, it was a little bit positive. I think both of those numbers are both 0.4% rate increases. And actually, they're quite different. In 2020, no one was really doing any sort of rate changes at all. In 2021, because of COVID, different carriers were submitting different types of rates, and they kind of balanced each other's out. Some carriers were increasing rates, some carriers were decreasing rates, and it kind of averaged out to a little more than zero. Then you see 2022, big increase. Now, remember, this is rate changes that were filed. So 2022, there was a great increase in the amount of rates that were required. Now, remember what was happening at that time. Due to COVID and the pandemic, we saw lots of inflation. We saw lots of supply chain problems. Remember, it was very, very difficult to find used vehicles. And so those were effects of that economic environment. We saw a little bit of a delay, but then it affected insurance. So in 2022, we saw increases. 2023, we saw increases. So then we come down to 2024 and 2025, things start to level off a little bit. And now in 2025 and 2026, we are still overall seeing a very small overall decrease in these rates. Now this is just rates that are filed. Many, many different factors go into actual premium. And so, policyholders may not see a decrease in premium, even though rates are decreasing, depending upon what kind of policies they have, what they're choosing for coverages, what kind of vehicles they drive, what kind of personal driving experience they've had. They've had prior losses. If they've if they bought another vehicle, an additional vehicle, premium is going to get more expensive. But generally, overall, we've seen rates come down. Not everyone, though. Some carriers are reducing their rates, and this is to the commissioner's point at the beginning. We've seen Nationwide, Amica, State Farm, Travelers. So I put there Liberty Mutual. Liberty Mutual is a large corporation, has many different insurance carriers depending on the types of policies that they're selling. Some Liberty Mutual companies have reduced their rates, and that's what's represented here. And you can see, even with these carriers, there was an uptick in 2022, 23, and even 2024. But now in 2025, and I've seen some in 2026 that are taking effect in 2026, that these rates are coming down, which is great news. However, it's not everyone. Others, not quite yet. We're hoping to see other carriers follow suit. And this is not intended to call out any particular carriers. These are the large carriers writing large portions of the business in New Hampshire. these carriers have not yet seen rate reductions. Now, they've also didn't have as large increases as some of the other carriers, and so they may have been a little more conservative in their outlooks. So they're not as, the swing isn't as high, and so they might still need to have some more rate. But what I would consider normal times, it is not unusual to see a couple of low single-digit % increases as the general economy and inflation gets increases. So just to recap, New Hampshire personal auto insurance market is experiencing a positive turn. Generally speaking, overall rates are stabilizing and some actually seeing reductions. Frequency and severity trends are returning to what we saw pre-COVID. For whatever reason, as you remember in 2020, during the peak of the pandemic, folks weren't driving places. Folks were at home, and there was really no place to go. And then afterwards, what the industry saw was an uptick in loss frequency and loss severity. It appeared as if folks kind of forgot how to drive a little bit. And so, but more recent data is showing it kind of returning to where it was prior. So the good news there is that folks have started to remember how to drive safely. In addition to that, we're seeing a lot more cars on the road that have more advanced safety features, which are now there's early indications that is helping with the reduction of the frequency of accidents and claims. Now, of course, that also might increase some of the severity of when there are accidents, because of the costs to repair those safety features tends to get more expensive. So those kind of work against each other. Nothing's ever simple. Personal auto insurance premium trends, it's important to remember, they kind of follow the economy with a lag. Carriers will look at the experience to then set future rates. And so you'll notice that as the economy improves, there will be a delayed improvement of your auto insurance premium. Very important to remember that in the state of New Hampshire, the market remains very competitive. We encourage folks to shop your insurance. We see up to 100, I think we're at about 107 different insurance companies writing business in the personal auto market. Those companies are represented by 60 to 70 different groups. There are plenty of places to purchase auto insurance. And yeah, as I said, the market remains very competitive. So that's what I have. Are we available for questions?
Yeah, we certainly are, Christian. Thank you. That was very, very informative. We have one question so far, and I invite folks, if they have questions, to please put them into the chat box, and we'll get to those. Christian's happy to take your questions. We have James as well, so our whole team is here. The first question is, do you have a breakdown per carrier of market share?
Not with me. We do post a competitive market report. We try to get it out by June 30th each year. So last year's competitive market report is available on the website, and that will list all of the I think it's something like any carrier that's writing more than 0.1% of the market. It's like 60 or 70 insurance companies that are listed there. So, and that'll have the report for 2024. The new one will come out in June. We'll have it out and available by the end of June using 2025 data.
And there was somebody that posted a link to a file on our website. So
that was exactly the thing you were referring to, Christian. So thank you, Andrew, for posting that.
Was that AJ? I bet that was it.
No, it was one of our viewers.
There you have
Thank you for that. That was spot on. You knew right where that was. Do we have any other questions? I hope, Tony, that answered your question for you. And thanks to Andrew for the assist there.
Yeah, I do try to do it from memory, but it would be bad.
So, Andrew, I have a question. I have a question for Christian, if you don't mind.
Go ahead. Yeah,
so,
go ahead.
Christian, actuarial soundness. So there are kind of two pillars by which you look at a rate filing. So when a company submits rate, you look at kind of two things in addition to all the great math stuff that you do. So help people get a better understanding. What does actuarial soundness mean? What does it look like? Perhaps give an example, because on the one hand, I think it's fairly straightforward. You don't want companies coming in and trying to undercut a market and trying to gobble up a whole bunch of market share by offering artificially low premiums, because eventually, if there are a lot of claims, of course, you're not going to have the premiums to support the payout of those claims. So that type of tactic, I think, is fairly understood, and the reason we guard against that type of thing. But what happens if a rate seems very, very high, or what else goes into that calculation of actuarial soundness?
Yeah, so there are basically three things that the actuary is concerned about, and it's excessive rates, inadequate rates, or rates that are too low, as you mentioned, that could be very dangerous for the market, and then whether the rates are unfairly discriminatory. The whole nature of insurance and sharing risk, there is an inherent discrimination in there, but that discrimination needs to be associated with risk. So if there is a way to determine that one policy or one exposure is riskier than another, then it is reasonable to charge the more risky exposure more than the less risky exposure. What we need to do is really when those exhibits come in and when that rate filing comes in and they're demonstrating, the carrier's demonstrating a desire to charge one group of policyholders more than another, they need to provide evidence that that loss experience is indicative of this difference in risk. And then they need to coordinate those rating factors with those risk differences. And what happens is, again, I mentioned the term credibility. So there needs to be enough data in what they're presenting to be credible in differentiating these risk characteristics. And that becomes somewhat of an art, somewhat of a science, but the more information, so we'll go back and forth with the insurance carrier, those submitting the filing, asking them more questions, understanding where they're getting their data from, how recent it is it New Hampshire specific, and then we'll push back and we'll say, yeah, you've carved out too small of a bucket of policyholders, of drivers, and we just can't. We do not believe that this is fairly discriminatory. We're gonna ask you to hold off on that rate factor until you have more data, more experience. The commissioner mentioned the concern of collecting not enough premium. This is a big concern. Making sure that rates are adequate is very, very important, because there is the temptation for insurance carriers to undercut the market, collect market share. Again, you're not the nature of insurance is that you're not paying out on that product until after you've sold the policies. And so it is very important that we make sure that carriers are not manipulating the market for that purpose, because other insurance carriers will follow, and then it becomes very dangerous. Excessive rates, although not in our law, having it an excessive rate is not a means by which we can disapprove the filing, because we have such a large, robust, and competitive personal auto market. Again, when we receive a rate filing, we will question it. We will ask them, is all of the rate that you're asking for necessary? How will it affect your profit and contingency? Is it consistent with what your experience is showing? And we rely on the competitive marketplace for insurance and knowledgeable consumers to avoid paying more than they need to, and we are seeing that. insurance companies that may be overcharging end up losing market share.
Christian, we
Awesome.
do have another question. Michael DeLong asks, what is the impact of credit-based insurance scores on consumers' auto premiums? Is it causing their premiums to go up?
Generally speaking, credit-based insurance score has been used in New Hampshire for 20 plus years now, going on probably at least 25 years at this point. It is very much built into most insurance. I would say all insurance carriers use some form of insurance score in their pricing. So I would not say that credit score in and of itself is increasing premium across the board. Generally speaking, most carriers will apply an insurance-based credit score that the factors are, they work in tandem with all the other factors to differentiate correlation to risk. And it is something to consider. Each insurance company will put more weight on different, rating characteristics. And we encourage folks to shop their insurance. If it is perfectly reasonable to ask your carrier, how is my premium calculated? What characteristics, what rating factors are affecting my premium? And if it turns out that particular carrier is using credit score as a greater indicator or a greater weight on your premium, we encourage folks to shop around. That isn't the case everywhere.
Thank you. Hope that answered your question, Michael. Last call for questions while we turn it over to the Commissioner and Christian for any final thoughts.
Sure. Well, first and foremost, Christian, great presentation. I mean, really good stuff. This is obviously a complex topic, and the work that you do is unbelievably complex. So thanks for being a really smart guy. But one of the things that Christian and I are watching, and we're really going to be fascinated to see how this plays out over time. So Christian mentioned how one of the things that we foresaw or foresee as a bit of a cost driver or a factor that's going to put upward pressure on premiums is all of the new technology that's going into vehicles. And the vast majority of that technology is safety based, although there's some luxury pieces to that as well, of course. And we want cars to be safer. That's obviously a very, very good thing. But when those things break or when they're damaged in an accident, they're incredibly expensive to repair, as Christian mentioned. But what will be interesting to see is over time, does the fact that those technologies are preventing more accidents and they are bringing down the number of claims, does that balance out the cost of that technology? It's something that we're going to need to review and take a look at carefully over time. But I think the technology is here to stay. Nobody wants to go back to the Model T or the Fred Flintstone mobile where we're driving the car with our feet. So the technology is here to stay. So from a cost perspective, again, it'll be fascinating to see if the number of accidents and number of people not getting hurt and all of that balances out the cost and the expense of those technologies. So we'll be watching that very, very carefully as time goes by. But I really do want to stress something that, yes, Tony, absolutely. Staying off your cell phone while driving will lower accidents. That is absolutely true. So I appreciate that reminder. But I want to emphasize something that Christian said, because I know that there's probably a number of folks who are watching today's program or who will watch it on replay who will say, I don't see the company that I have on the list of carriers that are bringing down their rates. I want to be part of that. I want to be part of that good news. Well, as Christian mentioned, in one of the most practical, best pieces of advice that we could give to consumers is shop your coverage. Use an independent agent. Use any agent. Use them to help you get the best rates possible for the best coverage that you can find. You don't get any rewards for staying with an insurance carrier for 10, 15, 20, 25 years. There's no gold watch, there's no trophy, there's no plaque for that. You can be a little bit selfish when you're choosing your coverage. Pick something that's affordable for you, or as affordable as possible, that gives you the best deal and gives you the best coverage for you and your family, whatever the case may be. And as Christian mentioned, there are plenty of carriers to choose from. So it's a very, very vast field of competitors who are out there looking for your business. So if your company's not on that list, go out and shop the coverage. See if there's a better opportunity out there for you. And so with that said, I don't see any other questions, Andrew. So if not, I'll pass it over to you to conclude.
I appreciate that, everyone. Thanks for the great questions. And Andrew, thanks for the assist there on that document on our website. Next month, we're going to be partnering with the Department of Justice and talking with a couple members of their team with regard to something we mentioned in a consumer document this past month, and that is making sure your contractors have the right insurance when they're doing home repairs and projects around your house, but with the specific angle of making sure that elderly folks are not taken advantage of. So by all means, please check into that. Stay tuned to your email. We'll have some information coming about that in the next week or so. As always, you can check out this and all of our webinars on our YouTube page. We put a link in the chat box there for you to visit that. And we appreciate you joining us. Thank you so much.